Grégoire Chama. I'm a senior research and portfolio analyst here at Momentum. Our next speaker joins us from Jupiter Asset Management, where he is currently head of credit research and portfolio manager of the Jupiter Financials Contingent Capital Bond Fund, fund investing in European subordinated bank debt and one of the top performing strategies in the peer group since inception over 4 years ago. He joined Jupiter in 2013 as a credit analyst before taking on his role as head of credit research in 2019. Before joining Jupiter, he worked as a credit analyst at Moody's Investor Services as an associate credit analyst, and prior to this worked at Goldman Sachs as a financials credit analyst in the Southern European team. Please join me in welcoming Luca Evangelisti.
Good morning, everybody. Thank you for the introduction, Greg. So, as a brief intro as well, my focus, as mentioned by Greg, is primarily financial institutions, banks investing in general. So, in today's presentation, I will focus mainly on three topics, which are related to financial credit. First of all, understanding the impact of digitalization. I will not speak much about AI, but more in general about what has been the impact of all these technological advances over the past decades. Secondly, I will focus on financials specifically, so what kind of instruments are issued by banks, and I will focus on additional tier one COCOs, so the riskier end of fixed income when it comes to banks investing. And I will finish with the opportunity, the investment opportunity, putting it in context of today's valuation to see what are the differences, if there is any opportunity based on current prices. So I will start before going into digitalization. I think it's important to make a very quick overview of the banking sector, where we are now. The banking sector, as you know, has been through tumultuous years after a global financial crisis. One of the probably more important indicators that we as analysts will look at is capital position of banks. As you can see on the right-hand side, basically the capital of banks, so CET1 ratio or leverage ratio, has been effectively doubling even more from the lows of the global financial crisis to where we are now. We reached a sort of a peak already last year. Everything seems to be stabilized. As you can see on the left-hand side, also different banking sector, different banking systems have on average about 15% of CET1 ratio, which is a very high level, given usually the minimum required by regulator is around 10% or even lower. So on a capital position, banks have improved substantially. Another is the asset quality, so the quality of the banking book, effectively the loan book of banks. And for sure, you remember during the Euro crisis, non-performing loans, so the kind of bad loans issued by banks reached really a peak, around 6.2% of the total. Also, under these metrics, almost every bank in every country in Europe and also in the US have seen a strong decrease. So from the peak of 6.2% to now around 1.8, 1.9%. So again, also on the asset quality, we've seen stable improvement, which has led to higher profitability. The average ROE now on the left-hand side of European banks around 10.6%. There are some of them much higher than that. And I think it's interesting on the right-hand side, this summarizes in a way the cumulative net income of three banks that went into some sort of troubles, especially after the financial crisis. So UniCredit, Deutsche Bank, and the Monte dei Paschi di Siena, which, as you can see here, actually they had to raise around 70 billion euros after the crisis in order to make up all the losses that they went through. So really tough times, and then now back to profits, which are actually higher on a combined basis than the pre-crisis peak. Of course, helped by rising rate environment in the last few years. So also on the profitability side, we see strong improvements. But now, so how can we? What are the elements that we can try to understand whether or not digitalization had an impact on all of this? And there are not many metrics around it. So one of the key metrics that is used by the analyst community is efficiency ratio, which is a cost-income ratio. And in these slides is goes back actually after Second World War, and it shows the evolution of cost-income ratio for banks, going through very important milestones in the technological evolution. So from first credit cards to the introduction of home banking, internet banking, mobile banking, and most recently also AI. And I think there are two key considerations from these slides. If you see from the 1980s, when home banking was introduced, you see cost-income ratio actually was at the worst in a way, so very high, around 70%. And that came down substantially in the following 20 years to around 57%. But the second consideration, which is less obvious, is that from the early 2000s until now, actually the ratios remain the same, so around 57%. If anything, actually slightly higher. That's an interesting slide put together by the Autonomous Research. And actually, it deteriorated during period of crisis, and just only recently improved back to the levels that they used to be in the 2000s, thanks to the improved profitability that I showed before, which of course increased the denominator. So why? So the question is, why are we still at the same level? And there are, if you look at ways that banks can reduce this cost-income ratio, so try to lower the fixed cost, one classic and way, the first that comes to mind is the reduction in bank branches, which are less useful as a result of all the kind of development and the spread of internet banking and mobile banking. On the right-hand side, so the slide is not very clear, but the average is 35%. So that's the reduction of branches in the last 15 years, from 2007 to 2022. And that seems to be a relatively high number of branches reduction. It varies across the board from the most digital focused banks on the left hand side, including BAWAG, NatWest Group, for instance, to the least one. In average 35%, it seems a lot, but it's actually not that much. The analyst expectations were much higher than that, was close to 70-80%, so we're still far away from there. And the proof of that is that if you look at on the left hand side, that shows the more anecdotal evidence in countries like France, for instance, Germany, Italy, so very large banking systems. Actually, the number of banks branches still exceeds the number of petrol stations, for instance, and even post offices, which is somewhat counterintuitive given the strong development of banking and mobile banking. So there is still, again, work to be done. Some banks have done it, but many that still have cost to save through this. Another indicator, in a way, of how digital has helped banks to reduce costs is the headcount reduction. So obviously, processes are more automated. You need less people in branches. You need even less people in the head offices. So on the left hand side here, I'm showing how the headcount in the domestic banking system, or different domestic banking system, has evolved. You can see actually quite a strong reduction in some countries like Germany, France. But if we focus mostly on the last, let's say, 7-8 years, you see that only the UK, for instance, managed to reduce by 4.1% the headcount as a banking system. But other countries like Canada, Sweden, or even the US actually saw an increase in that. So again, also in this perspective, there is more cost savings to be done and better synergies to be achieved. But so why, despite there has been some cost savings, some banks actually reduced branches, on average 35, headcount reduction on average happened around 20%, but still the cost income, the cost, especially the numerator, is still relatively high. One of the reasons is that with the rise of digitalization and digital banking also, we've seen an exponential rise in cyber attacks, and especially in the financial sector, as you can see in the left-hand slide. With that, obviously, there are costs associated to deal with the aftermath of the attacks. So there's a financial implication, and also for preventing attacks, banks are spending more and more in cybersecurity prevention, and their budget is increasing in every continent, actually. So that obviously increases the cost base, resulting in total spending for IT-related services, including cybersecurities and technology at firm, rising, basically to a level which is around 10% of banking revenues, or also around 12 to 15% of total cost. So that's one of the reasons why it's hard for now to keep efficiency ratio in check and continue those improvements that we've seen from the 80s to the early 2000s. I mentioned cybersecurity. I think one interesting development this year has been from the regulator, from the ECB. So the ECB usually conducts stress tests on the balance sheet of banks, on the capital position. They impose capital requirement. For the first time this year, actually, they are looking at the cyber security, at the cyber risk, and they conduct a cyber stress test, looking at what would be the consequence, how banks deal with a successful cyber attack. The good news for the banks in a way is that the ECB is not imposing any capital requirement as a result of that. But my personal opinion is that we will get there, and this probably will result in additional costs, in additional capital requirements. So less ability to lend to the real economy, but more capital inside the banks, which for fixed income investors is not a bad thing, but again, it will not improve the cost picture of the banks. Just to summarize this first part, is important. I mean, I'm a credit investor, but also looking at the equity side, looking at banks' equity performance and the differences in valuation. Analysts have noticed that there is actually no much premium for those banks that are digital leaders compared to the laggards. The only positive comes from the expectations that the jaws, so the rate at which revenues will increase compared to cost, is positive for those banks more advanced technologically. But apart from that, again, there is more valuation premium in the current valuation today. On a credit perspective, actually, it's even less than that. You really cannot see any differences, even if you pick the top, the banks that reduce the most branches or are more automated compared to the least one. The differences in credit spreads, and we'll get through that later, are really minimal. So again, it's really not impactful at the moment on fixed income investments. And again, as I mentioned, cyber risk is becoming more an area of concern and very important for financial stability. I'm introducing the next section, just summarizing here, moving to the valuation side also, what's the performance of banks' equity. This is in the dark blue line compared to banks' credit, simplified by tier 2, so the fixed income instrument, subordinated instrument issued by banks over the last 20 years, which is a bit counterintuitive. You would expect banks' equity to perform better because equity is actually riskier than fixed income. But apart from the initial stages before GFC, actually we've seen a very divergent performance. Only recently, due to rising rates and higher profitability, banks' equity is catching up to some extent to banks' credit, which nonetheless perform much better. So this brings me to banks' credit, to financials credit, which is an interesting area. Many people think there is more of a specialist area, and it is in a way. But it's important to notice that about a third of total corporate debt, so not considering government bonds, but just corporate bonds, is represented by debt issued by financial institutions. It varies in Europe. It varies by countries, 34% in euro, 45% in sterling, and less in dollars, 28%. So it's a big part of the market. And COCOs, which is going to be COCOs or additional tier 1, which is the same thing, represent a smaller portion of this, so about 2%, 4%, and 1%, but still in aggregate around $250, $260 billion now. So it's still a relatively large market, despite being much smaller than the overall financials. So what are COCOs? What are the instruments issued by banks? And here I don't want to go through all the different characteristics, but in a nutshell, additional tier 1 COCOs are effectively, as I said before, the most subordinated fixed income instrument, very close to equity in a way, because they are perpetual, but also close and more similar to bonds, because effectively they are bonds, and they are callable every 5 years, 7 years, or 10 years. So the banks issuing it can decide to retire it. And based on recent history, and the history actually of this asset class, that's effectively almost always been the case. So in this case, they're very much like a fixed income instrument. The key characteristic of COCOs, which I'll come to that also later, is that they're considered going concern instruments. So they are issued and they're being conceived with the idea that banks can use them in case of trouble. So before going into a default, before going to resolution, those instruments are supposed to take losses and to help the banks to recapitalize and go ahead. So they're considered going concern instruments. In reality, and I'll come to that later, is not what we've seen in the market, which creates, in a way, a valuation mismatch. In a more simple way, in a more kind of a graphic way, that's where they sit. Sorry, the slide is not super clear, but in the circle area there, that's a capital structure of banks going from equity all the way up to senior or even covered bonds in order of seniority. And as I said, they sit just above equity, but below tier 2, below standard senior debt. And one of the more interesting characteristics is also the way the coupon works. So let's say an additional tier 1, a COCO is issued at 7%. In a period where interest rates in the market are, let's say, low at 1%, so with a 600 basis point initial spread. Now, this initial spread remains the same through the life of the bond, despite the fact that the bond can be called or not. If it's called, of course, it's retired. Banks need to issue a new one. If it's not called, the coupon is recalculated, considering the now prevailing interest rates, could be 2%, 3%, or 4%, or lower, of course, resulting in a higher coupon in a rising rate environment, which has been the case over the past few years. It's still the case, even if rates start to come down. Probably we'll see today with the Fed as well. But nonetheless, banks are now still refinancing bonds issued many years ago with a much lower coupon into bonds that actually have a higher coupon, which still keeps a very good valuation in the sector and very high carry in terms of income produced by these securities. This is in a way, I don't want to go into the details, but one of the risks of these securities is the capital trigger. So they're considered going concern because theoretically, if the capital of a bank, which is that the first chart I showed you, which in average is 15%, if it drops below, let's say 7%, which is a common trigger level, the COGOs are converted into equity, the very diluted price, or written down. So it's a really almost total loss event, which is effectively what happened with Credit Suisse last year, although with some technical differences there. This risk is very remote. In the example I brought here, I'm showing Nationwide, which is a building society here in the UK, which has a 27% CET1 ratio, even under really stressed conditions. So applying also our own internal stress test that we do on top of the one that the regulator does. The buffer still remain, is 7.7 billion now, it's 7.1 billion after stress. So just to show that this is clearly a virtuous example, but many banks are in a position where the buffer are so large that, yes, the losses needs to be really, really extreme to get even closer to that level, which makes these instruments, again, more of a gone concern instrument rather than, at that point, at the 7% capital point, banks are usually already in default, already gone. So again, another argument to show you that this is really more of a gone concern, like a normal subordinated debt. The point I wanted to make in this slide is simply the dark line at the bottom is the share price of Credit Suisse, and the share price of Credit Suisse in the last year, effectively, of the life of this institution, going basically from almost a little bit above par, let's say a little bit above 100 to 0. And the other two lines at the top are, three lines actually, are COCOs, so additional tier 1 bonds issued by Credit Suisse in the past. And what happened here, which again proves my point of being a gone concern instrument, is that Credit Suisse decided actually not to use the discretionality they had on the coupon. Any bank can decide to switch off the coupon of these bonds, right, in case of difficulties. But in reality, there is no bank in the history of this asset class that ever decided to switch off the coupon discretionarily, so to avoid the stigma associated with it. So what happened with the gray line that you see at the top is that there was a bond coming up to refinance in June 2022. The bank was already going under stress. In a way, the share price was already down more than 30% in the year. The bank actually decided to refinance it, so to pay par back to the investors and issue a new one with the coupon going up in price from 7.18% to 9.75%, so paying up more than 2 points to the investors. Again, that's happened, continued. The price, as you can see, remained very stable, close to par, until the point, obviously, when it was effectively bought, rescued, so to speak, by UBS. And based on the decision of the Swiss authority, these instruments were written down to zero, as you would expect in a resolution scenario, in a pre-resolution scenario. So again, proving the point that all this discretionality, all these triggers actually are redundant where the banking system is now, but this act actually only as a going concern, despite paying very high coupon. As you can see, it was paying 9.75%, and most banks now are paying high single-digit coupon to the investors. So, moving to the third part, is there any opportunity in subordinated debt? So, subordinated debt issued by banks, first of all, let's look at default risk, especially with all this talk and discussion in the analyst community about whether or not we're going to slow down. There is discussion whether or not we're entering into recession potentially in the US. This is the default forecast on the left-hand side of major industries by Moody's. This is 1 year default rate forecast. Banking is at the top in the sense that in Europe is expected, the default rate is expected to be 0.4%, in the US 0.1%, which is more comparable to utilities or very low-risk sectors such as the electrics or water companies, or other sectors, obviously not cyclical, which are expected to a much higher default rate, varying from 2 to even 5 or even 6% for construction and building. So again, this is just a forecast, of course. There could be differences banks by banks, and of course, the situation like Credit Suisse can always happen. But at the moment, this is the expectation in default rates, and the defaults in the banking sector are very low. So comparing, this is a slide that I show almost every presentation, and it ranks effectively all fixed income instruments, all sectors that you can invest in the fixed income world. So starting from AAA bonds at the very bottom left, yielding really small spread compared to government bonds, all the way to CCC corporate bonds, which are defaulted companies. They yield a lot, but they're almost defaulted, and their default risk is super high. So COCOs are the second, effectively the last on the right, the second last from the right, at around now around probably 7% yield, which is very interesting if we compare with corporates, for instance. So corporate bonds and non-financials rated single B, so very low in a way, so with relatively high default risk, they yield less than COCOs at the moment, so 6.3%. And you may wonder, okay, but COCOs are more risky. But if you look into the composition, so this is at index level on the right hand side. So you have COCOs index broken down by ratings. So what type of ratings are the instruments in this index compared to the high yield corporates? And you see that actually in the COCO index you have a quarter that are triple B, so investment grade rated. The rest is actually double B, which is a good sub investment grade rating. Whereas high yield at index level again is there are double Bs, but there are also single Bs and below. So on average, lower rating compared to COCOs, which is double B plus on average. And again, COCOs at the moment offer a higher yield. Just a couple more slides on valuations. And so I talk about yield, the previous slide. This is spread, so kind of the risk premium given by the specific institution that you invest in. And again, on the left-hand side, you see the black line is the spread offered by COCOs compared to Tier 2 and Senior, which are these other type of debt issued by banks. You can see, again, despite the strong tightening from COVID times and from Credit Suisse times last year, still you see a big gap from additional Tier 1 here and Tier 2, for instance, and Senior. Again, denoting a perception of the market of a much higher riskiness of this asset class compared to Tier 2, which ultimately, Tier 2 is also an instrument that can take losses, of course, in case of defaults, and it's not secured the same way they're not secured AT1s. And then moving to non-financial, so comparing AT1 to non-financial corporates. So you have, again, the spread of additional Tier 1 around the high 300 basis point versus double B corporates in the US, which has surprisingly tightened substantially despite also the situation in the economy. And again, showing a gap which is almost 100 basis point, which again we think is excessive, and it should narrow down in terms of COCOs narrowing down towards the double B companies. And lastly, you might know also there are COCOs are issued by European banks. US banks, they issue preferred shares, which are very similar to COCOs. The only difference is that there is no explicit trigger for write down, But as I said before, the trigger is quite redundant because the bank will be already defaulted by the time they reach a trigger. So that makes very similar the instruments. They're both discretionary in terms of coupons, but they trade, again, due to perception, trade in a very different way. And again, you see still a very high spread for COCOs, the orange line, compared to pref security, which tightened substantially. So that's in a nutshell. Just give you an overview of how we see the world in terms of countries that we invested in our fund very briefly. And we maintain a very positive view on the UK and also in some peripheral countries. The UK, due to the low risk, also the valuation still reflects some uncertainty and some concern about the housing market and the mortgage market, which actually we don't think they're funded. So we are quite, also the example I mentioned before about Nationwide with the stress test we do in our part of the day-to-day job, we are very confident about the resilience of UK banks at the moment. We also like Spanish banks, both the top banks and also the smaller banks, so the kind of middle-sized banks. In Italy, France, we are underweight compared to benchmark and peers. We like less the political situation and the fiscal situation. And in Italy, we like mostly the two large champions, so the Unicredit and Intesa. Whereas in Germany, also we have a strong underweight, as we are quite concerned, apart from one or two institutions, we're quite concerned about the economic landscape and the potential effect still of the commercial real estate market. Just to conclude, basically my key takeaways of the presentation. So the first part, I would say my conclusion is that digitalization is not has not a strong impact so far on banks' fundamental. We've seen a lot of improvements, but not due to that. It can change. There is still room for improvement for many banks, but at the moment, we're not seeing that much into the numbers. Secondly, on financial credits, it's probably an underinvested part of the market, and I think it still provides lots of opportunities due to this misconception of risk of the instrument, especially in the COCOs space. And valuation-wise, again, COCOs, I think the most striking thing is, again, the comparison with high-yield corporates, which sometimes are perceived as safer, but in reality, they are lower rated and lower yieldier than standard COCOs bonds. So I'll stop here. I'm not sure how have I done with time, but I'm sure there is time for questions.
Luca, this is a very specific subsection of the market. What can an investor expect as a return from this asset class? What should our reference be?
Yeah. Okay. So I'll tell you the return year to date has been relatively good. So in the first 8 to 9 months of the year has been around 10%. I think it varies. Obviously, last year was a very particular year due to Credit Suisse, so returns were skewed at index level by Credit Suisse. But normally, if you think that the average coupon now issued by COCOs, subordinated debt, is probably around 7-8%. So that's a carry that you would expect. If you believe in what I mentioned before about the potential for compression in spread, that can add more, of course, in terms of price appreciation. So at the beginning of this year, I was guiding guiding investors for a 10% plus year. And we're already there, and we have still 3 months to go. Probably I wouldn't say the same for next year. I wouldn't say there is a 10% plus year next year because spreads are already more compressed. But the way the coupons are and the spreads are is still high single-digit kind of a returns expectation for in a normal year, I would say.
Luca, thank you for that. There's a new generation of digital and disruptor banks waiting sort of in the private wings. As they sort of mature and come to market, will they be joining this party or disrupting it?
Yeah, look, it's a good point. There are many fintechs that are just now, entering the market and trying to compete with banks. On a fixed income perspective, we haven't seen much because the size of these banks is still too small to actually issue this kind of instrument. So the average size, for instance, in the COCO market is between $500 million to $1 billion in terms of size of instruments every time they issue a COCO. So it's really large, and so usually only very established, very large financial institution can access this market. The fintech are trying to now, they're usually funded also by the private credit, or mostly by private equity, of course. So they're trying to compete, and they are indeed competing in certain businesses of the large banks. But yeah, on an instrument perspective, I don't think we will see any issuance from these kind of companies probably in the next few years until they become really big. But on a business perspective, yes, they're creating noise, they're creating competition with banks, but they don't have the scale yet to really affect the large customer base and the many revenue lines that the banks have.